You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor series, where we share our experiences, the ups and the downs of what it's like to be a rules-based investor, and of course, where we also take your questions. So, good morning, Jerry. Good afternoon, Moritz. How are you guys doing?
Good morning. Good afternoon. Doing great.
Yes, doing great.
Yeah.
I'm in Minneapolis, Minnesota today for the college basketball Final Four. UVA, my team, is here as well. So, kind of chilly, but nice to be here.
Fantastic. Good stuff. Perhaps also a little bit chilly on the geopolitical front this week compared to previous week. Kind of familiar picture in the markets where risk on is back on the agenda. Stocks benefiting, energy benefiting, bonds maybe taking a bit of a breather. And of course, our friends, the lean hawks, that story continues with another 12% rise this week, which we now know is due to an African swine fever, which apparently has emerged in China. And just to put things in perspective, I read this morning that they're looking to cull 100 million hogs because of this, which is a pretty big number compared to the total inventory in the US of 74 million. So pretty big numbers. I wonder, before we jump into our usual format, whether we should dwell just a couple of minutes on last week's conversation, where, of course, we were joined by Jesse Felder, who very kindly took time out of his weekend to join us. And I thought it was an interesting conversation. I mean, clearly, Jesse is not a systematic investor, but I certainly felt that there were a lot of interesting takeaways when it came to his views on trend following. I mean, one of the quotes I really liked, he said something along the lines where, you have to make sure you pay attention to the trend. If it's good enough for Paul Tudor Jones, it's good enough for individual investors. So, clearly, embracing the things that we do. And also, I think he was basically saying that in terms of the tools in his toolbox, when it came to timing, he was definitely looking at trend following because fundamentals are not a good timing utility. So what were your takeaways from the conversation, if you remember, so to speak? Sometimes it can be difficult to remember one conversation from another, but I mean, if you think back, what were your takeaways from Jesse?
One of the things I remember, and I really love that one, is that make sure you pay attention to the trend. If trend following is good enough for Paul Tudor Jones, then it must be good enough for me. And it's like, yeah, 100% agree with that.
Sure. Yeah.
Yeah, and I think that almost regardless of how you approach the markets, probably the biggest mistake that everyone has a tendency to make would be getting out of winning positions too soon.
Right. Yeah.
We just have so much regret staying in and watching the profits go away and other people are already out, and we look silly. Two trade charts positions come to mind this week. Massive profits last year in natural gas. Didn't end up as positive on my books. The hogs, hard to get into, slippage, and then crash, and then back to new highs. And then palladium, nice trend, crash, feeble attempt at a rally, maybe closer to back to the recent lows. So each trade is sort of random. You don't know really what to do, and you don't want to look silly. But in the long run, I think the reason that the computer says you should use longer-term trend following is that it has a tendency to work. And these big sell-offs have a tendency to go back at least a few times and make new highs and keep going. So everyone is faced with that same thing of emotionally getting out of big winners too soon. I know we had one listener talk about a trade. He was in short, was it yen, in 2.5 or 2 3/4 years, and They're rare and they're tough, but very rewarding.
Absolutely, we'll come to that a little bit later as one of the questions. But I think the also some of my takeaway from the conversation is the fact that we talk about trend following in a very specific way, the way we implement it, rules based, classical sort of CTA style. But of course, I think what Jesse was also alluding to is that trend following can be used in other ways. And I just see here on my screen that there was a quote that he said, which something along the lines, compared to all the possible methodologies an individual investor might use to try and time markets, #trend following is by far the best or one of the top ones. And I think that's the other thing. I mean, of course, we would prefer people convert completely to our way of thinking, to our way of implementation of the strategy. But just the core concept of trend following, the fact that it can be used in different ways, even if you're not doing trend following exactly how we do it, it still has and it still offers a lot of value. So I thought that was interesting to hear from someone like Jesse. But anyway, that was last week. Now today we are focusing on this most recent week, of course, and as usual, Moritz, why don't we start out and see how the week panned out for you in the markets and so on and so forth?
Yeah. Well, this week wasn't all too good. I think you've just mentioned it, Niels, that we had a big of a breather in the bonds. So the bonds produced quite some losses, about -3% for this past week. And it's across the board, be that gilts, JGBs, 10-year notes, spoons, all of that. I'm long, and those markets went down, so that wasn't good. The equities, I have a mixed bag of longs and shorts, so that was balanced. Energies lost a bit of money. The short positions in heating oil and gasoline, they also suffered a bit. A little bit of money from short gold and short silver. And making money from being long the emissions, which came back in the last week. But even though it was a -3% week, March was overall a good month, more than 10% in gains. So that's positive.
Sure, very classical kind of week of a bit of correction. Very similar experience that you just mentioned on our side. Commodity-wise, there are only 2 blue bars I see here on the last week. We made some money in cattle and coffee. Everything else was red. All the fixed income was in the red. Equities actually did okay for us. Mixed, but overall positive. And currencies did pretty well. And of course, we know the dollar index is, flirting with new highs. It'll be interesting to see if that breaks out, what that might do, not just to the currencies, but potentially to other sectors as well. So yeah, pretty quiet overall, I would say, and of course, markets have to have a little bit of time to digest some of the big moves we've seen, and of course, that has attracted a lot of attention. I think in the media, I don't think many people had kind of seen interest rates go as low as they are now again. So again, having no opinion about these things sometimes can be a great benefit. But of course, equity is doing really well, up 16-17% now for the year. We've forgotten all about bear markets from December, Jerry. So how is that playing out for you?
Pretty well, yeah. Just slowly adding as individual markets become longs, and small short positions are usually getting stopped out for losses. So playing the single names and taking advantage of the diversification for this year continues to be positive. I left off emissions. So yeah, that was another one that kind of went up, went down, went back up, crashed, going back up now. So, the only thing worse is kind of like doing lots of trades in that area, I think. So giving back is kind of a problem, but sometimes it's fleeting. So that's another really good trade. The dollar looks good. Platinum had a big move, something going on in platinum. It was the weakest of the precious metals for a while, but a big up move there this week, short to long, something different. But I'm looking more favorable for the markets. As I go through the charts, there a lot of low volatility, which is sort of good when the markets sort of just break out and get going. You want the vol to kind of be low. People not that interested, and then maybe some long commodities in the metals. Hopefully that'll continue. So looks like some different things are happening in the markets that should be positive.
Yeah, no, I agree. It does look interesting. So in terms of attracting attention, attracting some love from your followers in particular, Jerry, I know you said it's been a quiet week. What did catch people's attention though from your activity in that space?
Pretty quiet week for me on Twitter, but I'll pick out some of the ones that were more popular. This one is about recency bias, and it says recency is a tendency to overweight recent events, trends, and ignore long-term evidence. This results in the opposite of what a disciplined investor should do. Memories can be short, often much shorter than is required to be successful. That's a very good self-serving quote for us trend followers.
Yeah, I don't know where that came from, but I definitely saw, maybe it was in the latest weekly newsletter I get from Annie Duke, that there were also, she also wrote something along those lines this week. And I think it is important. I mean, I think it is, and it's an important feature of what we do to help investors deal with these different biases that we have. Even though it's something that maybe typical investors don't think about too much, that they're actually battling some really strong forces within themselves when it comes to investing, and usually forces that are not beneficial for you as an investor. And that's kind of one of the hidden benefits of just following a rule-based investment strategy, whether it's trend following or something else, that as long as it's rule-based, it really helps you deal with those things. So I think it's an important topic.
And everything we do is based upon these long back tests where we look at all the data, and we may not really like what the computers are telling us, but to be longer term, to be patient, to suffer losses, to be more flexible when it comes to open trade profit drawdowns. But it's not like we're just making this up, and we definitely don't think it's worthwhile to concentrate on shorter term performance metrics. So I think it's very important to understand that we have this powerful evidence that's not just with recent data. Another one, which sort of is the same thing, look at long-term performance, was over the long run, markets don't exhibit the same tendency to suffer or crash together. Thus, investors shouldn't allow short-term failures to blind them to long-term benefits. Even though it looks like it sometimes, that these markets do all kind of crash at the same time and everything goes to one, and the diversification is not really helping very much. You can over-diversify. That's a silly quote, but for a systematic manager, you can't really over-diversify. But I think, once again, you just got to, what works in the markets is suffering some pain, suffering some underperformance. We've talked about that, how it's almost everyone who is an outperformer over the long term has a tendency to be more of a underperformer for longer periods of time. So it's kind of a perverse way of having to deal with the markets, but it does seem to work.
Yeah, there was this great article, and I can't remember whether it was something I shared with you guys or you shared with me, but there was this article where a guy had shown visually how markets tend to make a new high, and then how long it takes before they make a new high again, and so on and so forth. And I think people forget that there has been so many periods throughout history where equities have gone for years without making a new high. Yet in our world, we get called out if it takes more than a couple of years since the last new high. which really isn't that long time when you compare to many markets. I mean, people probably already forgotten that it's 6-7 years ago gold made a new high. I mean,
those new highs, I was just thinking I'd be equally happy if markets make new lows.
yeah, good
I'm
point.
not biased to the long side on that. So if markets make new lows, that works for me in the same way.
Yeah, I think that's a great point.
Everybody's focused on the highs, it seems.
Yeah, another bias.
Passive long only, right? There you have it.
Yeah. What else went on, Jerry?
There was a lot of Twitter from myself and others back and forth arguing on Twitter about overfitting, curve fitting, things like that. And I'll summarize by there was a quote from I think the Bloomberg article we talked about earlier that said the dynamics of markets evolve so quickly that CTA systems that have been fitted to the past will not be easily valid for the future. My opinion, I think that is, it sounds like if you do this great back test that I mentioned earlier, that, it's fitted to the past. It won't be valid for the future. But I don't think that's correct. I think maybe a misreading of the quote, or I think the quote gives off the wrong impression. I think to some degree when we do these back tests, we choose our parameters, 20 by 200, 50 by 200, 50 by 250, whatever it is, the trend following entry exits and all the other things. Of course, we're looking at what has worked in the past, and maybe you'll trade a couple of those entries and exits or a dozen to diversify, but probably mostly medium to long-term trend following, probably most highly somewhat correlated to each other. When every system gets in and you ride a trend for 2.5 years, the correlation in all those systems is like 100%, right? You have to wait for the exit to sort of see some diversification on your P&L for the trade. I think there is something called overfitting, where you try to look at too many of the exact zigs and zags in the markets, and your system has too many variables and parameters that it is sort of fitted to the past. So I think a light, gentle approach that looks at past parameters and sees sort of what philosophically works, especially if it has one of the key ingredients, which is it has big drawdowns. I think that's like the key. Choose something that has a light touch that keeps you in gear with the trends. It's not trying to have too much precision, and really allows for the markets to really fluctuate and your P&L to fluctuate on the trades. So you can have a trade that's 2.5 years, if possible, if the major trend stays intact. So I think fitting and overfitting, I'm not an expert, but I believe it's two different things.
Yeah, I did see that Twitter exchange with Wayne, and I think I even left a comment, during that conversation, a little bit going, I mean, and maybe being a little bit, devil's advocate here, but I mean, if we all agree that nobody knows what the future will bring, I mean, how much overfitting can you really make or do? I mean, you can only do, but I think another way of thinking about it is that often I think we are, I don't know if criticize is the right word, or maybe people are skeptical about a strategy like ours, where you kind of look at the past and then you, as to help you create a strategy. But I mean, I wonder if Warren Buffett is doing anything different than that, right? I mean, he believes in a certain approach. He believes in value investing. So he obviously has experience from using a strategy like that, and I'm sure that's what he bases his philosophy on, right? And we do the same. We just don't get kind of the same positive feedback loop for doing that, sticking with something that has worked for us in the past. So I do feel that there is a little bit of a double standard. I know you mentioned, Jerry, this Bloomberg article that came out after our conversation last week. So it's kind of an update on performance, not from the same guy who wrote the article on March 1st. The trend following, was failing. So these were two other journalists writing about trend following, maybe mainly to give a performance update on a strong March. But even though it is true, it's just 1 month or a couple of months where trend following is kind of done well again. There wasn't a lot of love in that article either, I thought, when you read between the lines. And maybe we don't need, as you and I talked about before we started the recording, maybe we don't deserve a pat on the back just yet. But I do find that there often is a bit of a bias to, same thing about, the whole point about black box. What we do is a black box, as if something is wrong inside our models, and it's kind of we need to keep it hidden. I mean, some of the most loved strategies by investors, offered by the Renaissance technologies and these type of firms, and even what goes on inside a bank. I mean, how transparent are they compared to what we do? I think we are much more transparent than that. So, anyways, not sure why I went down that path, but there we are.
Like Moritz, do you have a theory on this fitting and overfitting, back testing?
Well, I think we all agree that what we need is a broad brush. Well, let me say I need that. I've never been too good with a sharp pencil on those trading systems. And, I don't want to say that, it's impossible to do it with a sharp pencil and the microscope and get all those little fluctuations out of the market and then make profit from them. Maybe it's just me not being able to do it, not smart enough to do it. But so I need that broad brush that works with, a small number of parameters in a relatively basic and robust way across all those markets. We've said that many, many times again. And then, we just diversify as much as we can to create the stability. Now that obviously then reduces the risk of curve fitting anything. But again and again, I mean, let's just be honest about that. Being able to test a strategy, a system, a hypothesis, if you will, with past data, that's extremely valuable compared to not being able to test it. Discretionary manager isn't able to test a thing. So it's just, the view of the manager on, the future world and how markets will move, but there's no history on how successful that could have been. I just, I just cannot come to terms with a strategy that works that way. There's always a bit of risk of fitting, but what's the counter argument? I mean, what's better than having a history and a sample and something to work with that, at least is in a certain way reliable. That's what I do. And it'll never change.
There we are.
I know maybe Niels, you want to come to that question on the volt curve fitting later on in this, in our chats, and then, I spared for that one, but I'm not sure. Do you want to speak about that later, or is that something for now?
Which is that one of the questions we received from our audience?
No, it was about vol control being curve fitting and things like this.
Okay, well, feel free to. We have no formal agendas, as our listeners well know.
No, I was just thinking maybe this is what brought this up, and I don't think we're using this vol control in the way that people think of vol control, but using past volatility. Past fluctuations in whatever way you want to calculate those, be that a volatility number, so that's a standard deviation, or kind of more like a range or an average true range. Yeah, I mean, there are differences in all of that, but at the end of the day, it's a measure of how strongly a market has fluctuated in the past. This, using this input to, come up with a position size for the next trade, of which you don't know how long you're going to be holding it for. By the way, we'll come to that later. It can be many years. And if that's the case, then that's normally a great trade. I don't see where any of that fits my curve to past data. It's just, maybe I want to hear your opinion on that. But, in my type of the way I use vol in my trend following trading system, the historical volatility of a market is unable to fit anything, in that system.
Right. I know exactly where you're coming from now, and it was a discussion we had offline during the week. I think the origins of this came from, and I'm not entirely sure where it came from, but it's this thing about if so volatility was probably more originally developed as a way to measure risk, right? But over time, and this is not so true for trend followers, because trend followers have used volatility all the way back from, the 70s and the 80s. Volatility has always been part of how we size positions. But nowadays, it seems like every single strategy under the sun uses volatility as an input to size positions. So I think the discussion and the question is there a risk now in the whole system because everybody uses the same input to a large degree when it comes to the risk management? So I think that was how I understood the debate. And funnily enough, I think on that front, trend followers has been far ahead of the curve here, because it's not I don't think we're doing things any different really than we did it 30, 40 years ago. But I think it is true. If you look at the whole spectrum, risk premium, risk parity, long short equity, et cetera, et cetera. I mean, all of those strategies today, including, I'm sure, a lot of other ones that I can't think of right now, uses volatility to a large extent to manage the risk.
Yeah, and if you look at vol control and you use historical volatility to manage a portfolio to a certain level of target vol, we've spoken about all those passive flows and the flows which vol control and risk parity and all of those strategies create, and there may be a risk with that, right? If the market turns around and then those flows which have built up maybe want to all exit through the same narrow door at the same point in time, which then creates volatility itself. The point I also got from that message was kind of like every time it's kind of like the dog eating its tail. You're using past volatility to forecast future vol, or using past data to forecast future data. I mean, that's what we do. In our case, vol is just the risk input or a part and an element of the money management and risk management system and position sizing system. But if you follow that logic, I'd say that every time you're using past data, you could say it's curve fitting, right? I mean, that's the input that we're working with. We just have to be careful that we don't overfit it and we give it too many parameters so that it starts negatively impacting our sample size.
Yeah, I mean, for me, that's two different discussions, right? Because I agree with you. There's obviously a debate whether you're fitting or overfitting. That's one thing, using historical data. But the other thing is just generally speaking, I mean, is the whole world now doing the same thing, using vol as an input in their risk management? And therefore, as you rightly say, we could end up everyone running to the exit at the same time, creating much bigger problems. And maybe that's what we've seen a little bit of happening in 2018, because we get these spikes of volatility now, and maybe that's a sign of a lot of things being driven by volatility, and therefore the off wind of positions when things like that happen is much stronger than it used to be. I don't know. I don't have a strong opinion. I'm just
Sure, and maybe nobody knows. I mean, there is this, global short vol trade going on, which we hear Chris Cole speak about, and it all sounds very logical and clear, and maybe, that's really happening out there. It's just, I wanted to, just speak for us as, systematic trend followers who don't use, or at least I don't use daily vol control and things like this, because I don't see the sense behind it. I'm using it to size a certain position. Once that position's up and running, it's up and running until it's, hitting an exit. That's it. So I don't really see myself in that, vol control camp that's running a global short vol trade.
Sure. Jerry, what are your thoughts?
I agree with what Moritz said. We have a simple way of deciding how many yen we're going to trade and how many crude we're going to trade. And we want to have sort of the same risk and the same expectation and the same juice in the trade. So, we use these methods we've been using for 30, 40, 50 years. And then we size the trade. We buy 10 crude and we sell 20 yen with sort of the same trade, kind of the same expectation. And then all of a sudden, a month or two later, if the trades are successful, the vols are totally different, and it's the positions are totally out of whack, and we don't really do too much about it. So we're close to the entry when we use that ATR approach, and so it's unlikely that it's going to be a big spike down, and we're going to get in trouble for trading larger because the vol was low. But I think after what gets us in trouble is 2 years later when the S&P hits a very low vol level after a huge uptrend. Well, now the constant vol targeting requires us to buy even more, maybe buy more than we've ever had before that we bought 2 years ago at the entry. And then, of course, another period rolls around shortly thereafter and the market crashes. And so now all of this crazy forced selling has to occur. So I think, that is a bummer and it hurts the markets. It's not safe. I've never been against reducing positions. If you want to take something off because the vol has increased 10 times. I had a trade once where it was, after just a few months, the vol was 10 times as large as when I put the trade on. Yeah, so scale back a little bit. But I do think it's particularly worrisome to start increasing trades. And it does seem like that is a little bit of prediction going on. And I think this was the point people were making. You're taking care of today. You're scratching today's itch. But you could be in huge trouble in a week or two and have to start dumping massive positions. So there's so much wrong with that idea that it's 2 or 3 different shows, I think.
Very true. How about some questions? Keep them coming. Yes, absolutely. Good reminder, by the way. Thanks for the reminder, Moritz. To all of you listening, we love getting questions from you. So please keep them coming by sending them to info@toptradersunplugged.com. That is the best place to get them in the queue. Now, the first question today is from John Z. It's a 2-part question regarding risk, interestingly enough. So a good segue into this. Are you always 100% invested with your AUM, or do you keep a certain percentage in cash at all times? In one of your past episodes, Jerry talked about pulling back some of his 25% allocation to fixed income. With 25% devoted to just one sector of the futures market, it made me think that you guys might be fully invested at once. I was just wondering how you look at using your entire equity. So, John, I'm sure Jerry will comment on that, but just as a maybe laying the foundation, because CTAs are known for just trading futures, we actually don't use much of the actual cash for making our investments and having the positions on that we want. So when we talk about percentages of allocation, we mainly talk about risk. We allocate risk. We don't allocate cash. So if we want to be, if we are 100% invested and 25% of that is towards the fixed income sector, for example, it's 25% of the risk. That may mean that we're only spending 20% of the cash as margin for holding on to these futures positions, and the rest actually sits in cash or cash equivalent instruments. So just to clarify that, we, unlike people who trade cash instruments, we have a little bit of a different approach to this. But anyways, Jerry, do you want to talk more about these things in terms of that, or?
It's really difficult to explain it. You did a very nice job, but it's almost like we're doing these trades, these bets, with no constraints. It's not in any way correlated or limited to our AUM and the money in our account. only to the extent that if we traded too large, it would show up in the daily returns as being very high and too high, So I think a typical daily return for us is plus or minus, 75 basis points. So we're taking these trades as they come with no constraint, without regard almost to, do I have the cash? Can I afford this trade? Allocate. It has nothing to do with that. So it's hard to explain, but
yeah, I mean, it's very true, and it's a good point. And I think that this is also where people may be looking from the outside and only starting to learn about sort of managed future CTAs can get a little bit confused, because if they look at the value of all the contracts we hold, clearly they're more than the value of the total cash we manage. And sometimes it's 6 times what we manage. Sometimes it's 3 times what we manage. I mean, it really depends on, as Jerry says, how many trades are we getting into? Because in theory, we should be able to get into every single signal we get within certain risk constraints that we have on the overall portfolio. But it's sometimes also something that causes a lot of concern from investors, the fact that you quote unquote use leverage, which we do, but we manage risk. I mean, that's the only thing we can really do. I mean, this is very important, I think, when you think about trend following and what we do as our fundamental core belief, and that is we have no control over returns, but we do control risk. So that's really what we mainly do. We're risk managers first and foremost, and we then take whatever performance we can get from the markets, within the constraint of our risk management. So, but John goes on, so maybe
if I could just comment on that, I would say that there's a couple of reasons why it sounds shocking that our AUM is a lot less than the notional value of all the positions, but I think it's important to sort of give you an indication of why that's the case, because we're being very responsible. I often use this analogy that you can take a Ferrari and you can go very fast, but it still does go 50 miles an hour as well. So you have this freedom and this ability to really go fast and use lots of leverage, or no, you don't have to. And by and large, most CTAs are pretty boring with their use of leverage, and it's the lack of trends or whatever that's causing the losses, not the leverage. But the reason we can get away with a position having more notional value than AUM is because of, I think, 2 things. One is a lot of the markets that we trade in are very low vol. And in order to get any profit, you have to leverage currencies and interest rates, let's say, and to get them to be equivalent to stocks, and now they're similar bet, the same bet. You have to leverage up and maybe, sort of leverage down the equities. And then number 2 is we're very diversified. So we're taking advantage of quite a bit of diversification, longs and shorts and currencies, commodities, interest rates, stocks. So if it was stock only, oh, no way. You would have to trade. You could not use very much leverage. But we're taking all of this into consideration. And the back test is saying, yeah, here's the sort of leverage you can use and not get into too much trouble. And if it gets too hot and heavy, just cut back and make it less.
Maybe to put some numbers to that so people get the perspective. Say if you have 100 million of assets, it's not uncommon for CTA to run that as a 300 or even 400 million notional account. If you take the sum absolute of all the notional contract values, just to make that relation clear. One of the things I'd like to add there, Niels, on the using all of the AUM, we've just, we trade futures contracts for the most part. And so everything we just said is on the futures. I think there may be some traders out there who don't use futures, who try to implement trend following strategies using single stocks, ETFs, cash instruments in general, right? And then there's also that dependency on what type of broker are you working with? Are you trading that on margin? Then it's kind of like equivalent to doing the futures trading that we've just spoke about. Or if you're not trading on margin, if you really have to, if the account size is the limit of the money that you can work with, then obviously that puts a lot of constraints on the way you need to build your system, and then it's entirely plausible that you may use all of your money to build a trend following trading system.
Yeah, and I think another good indication for people to be aware of, at least, is the fact that throughout 1, 2, 3, 4 decades for some of the firms that we represent, very often you see a very clear picture in terms of, when there's a drawdown, it usually gets to a more or less the same level, which is an indication of how much attention we pay to managing the risk. And we accept there's going to be downside, but we spend a lot of time making sure that it's not unlimited downside. Despite the fact that we use leverage, you could say that the losses. I mean, let's just take an example. The Nasdaq managed to lose about 80% without leverage in 2002. CTAs who use leverage never get near that amount. So talk about risk management. I think it's important to put these things in perspective. Now, John goes on the topic of risk with a second question. He says, I've read and also listened to numerous professional traders speak of they only risk 1 or 2% per trade. What I never read or ever heard was the total amount of risk that is a good general rule of thumb. If a trader risks 1% per trade and has 10 positions on at one time, is he not effectively putting 10% of his equity at risk at once, especially if some of those positions are in very correlated markets? It's very easy to have 10 losers in a row, especially if they're correlated. Let's say in my example, you have 3 positions in currencies, 2 positions in grains, 2 positions in soft, 2 in fixed income, and 1 in energy. Could diversification of this sort be the very reason for big drawdowns? And then he goes on to ask, what is a good rule of thumb in terms of total risk, et cetera, et cetera. I think you guys know where he's coming from, so maybe you can share your thoughts on this.
And by the way, it's a great question.
Yeah.
I like that question. And, one of the things that he just put into the question makes it clear that 2% risk per trade probably isn't the right number. It's far too high because you're running exactly that risk. You have correlated positions. They move at the same time, and it just amplifies your risk, your portfolio risk massively. So even 1% is probably at the higher end of things. And more like 50 basis points or something like that could be more balanced. The important thing here is to have diversification and not only trade the petroleum markets and then be surprised that they're positively correlated and they move at the same time, or only trade the bond markets and have the same effect. So you want to have, equities in there and, like Jerry, with all the diversification, even on the single stocks, get more out of that equity diversification, the bonds, the interest rates, the currencies, the commodities, massive diversification benefits from the commodities, and then long and short, right? And yes, theoretically, you could still have correlated moves in all of those markets, even with the diversified positions you have on. It's just very unlikely for that to happen. So, but it could happen. And having 2% risk on per trade then certainly is kind of like a killer number, far too high. So probably 50 basis points, give or take, 75, 25, all of that, I think, can work. But 2% is very high.
Yes, that we know, and that we can explain very simply. But the rest is pretty complicated. I'll just throw out some things like you're putting these trades on over months and months and months, so it's difficult to put on 10 trades in one day. Maybe if you're not paying attention to the correlations of energy, precious metals, grains, but a diversified portfolio is built over many months in many different entries over long periods of time. And how we sort of define this is if it goes against me and I get stopped out, I'm going to lose 25 or 50 basis points. Okay, so then you can come in one day and someone will ask you, well, how's performance today? Well, everything is down. I'm getting crushed. Oh, bummer. Well, not really, because I'm up like 20% for the year. It's all profit give back. So it's a bummer, but it does happen. So it's far different than the question, which is, wow, what if you have to put on 10 trades in a short period of time and you're risking 1%? Yeah, of course. So it's all in the back test. Look at it. I like to sort of make it almost impossible for me not to be able to afford, from a risk management point of view, to do the next trade. That's what I think is so important to remember is the back test is wonderful. It's perfect. It's great, but it does all the trades. So set up your money management and limit your loss per trade, your max loss. With that in mind, if I'm risking 1%, can I really do all the trades that come around? Probably not. You've got choices to make. You don't want to make choices. The computer took every trade. Trade smaller, risk 10 basis points, 20 basis points, whatever it takes. So when you do every trade, you're not in some sort of risk crisis. Now, volatility crisis, we're making good money, lots of open profit trades. They're really profitable. The trends are great. You're going to have some fluctuation. Two different things.
Absolutely. And there'll be many more discussions about risk and risk management. We appreciate the question, John, and also we appreciate the nice comments you have in your email to us, which have noted. Now, the next question comes from Woody. Woody has a couple of questions. So Woody deals on more with the investors who I think are more used to ETFs than perhaps futures. So the question goes, would love to hear more about the pros and cons of using managed futures in ETFs. The least popular, for the reason I'm not sure of, probably has to do with needing a benchmark and then compared to using them in an institutional mutual fund and of using them in a hedge fund. So I asked Woody to clarify that question a little bit. And he says, all I know is that they're offered, and I guess these are managed future strategies, for example, from Wisdom Tree. I'm not familiar with them specifically, and they're widely unpopular relative to managed futures in a mutual fund. Okay, so it's the whole ETF versus mutual fund debate, and also private fund. So it's more about the structure of the product that people would invest in, and of course there is some. We talked a little bit about this with Meb Faber when he was on. Because clearly, if you can offer something that is both, prudent for the investor, but also easy to access, like an ETF, that would be useful. But I can't remember if Meb talked about why in an ETF it wasn't that easy to do a pure kind of trend following strategy. Do you remember, guys, or do you have an opinion about this?
No, I don't.
Okay. Jerry, you have a mutual fund in the US. Is there a reason why mutual funds which is where all the CTAs seem to be going that route if they want to offer their trend following strategies to US retail investors rather than ETFs? Although there are maybe one or two ETFs out there now.
It probably has something to do with the way the additions are handled, where there's I think a market maker who has to go out and grab the positions and hedge and make a market and then buy the cocoa and the coffee and some of these liquid commodities. It's the hassle of doing that, I think, is. But some people have pulled it off, and frankly, I think, honestly, probably the ETFs are a lot cheaper for investors, and mutual funds are just fine. You get a little bit extra fee, so it's probably not a huge interest in turning my mutual fund into a ETF for that reason.
Then Woody goes on, and it's maybe a little bit difficult to answer some of these questions, but he says liquid alts haven't seen a bear market. Will they suffer from a big bank run in the face of a crisis because of their daily liquidity? So that's, I think, is a relevant question because we saw a bit of that in 2008. And then he goes on and say, do you really need leverage and concentrated position sizing to get the degree of convexity we all want from managed futures? So I think those are great questions. Moritz, Jerry, what are your thoughts about that? Otherwise, I'm happy to jump in.
Well, on the liquidity and the funds being used as an ATM, like you said, some of that is what we saw in 2008 and 2009 during the global financial crisis, where the CTAs became the ATM because other assets were losing money and investors needed liquidity, and they could find it with managed futures traders. So could there be something impacting the liquid alt funds? Yes, of course. I mean, if there is demand for cash, people need to get out of positions, need to liquidate their holdings, then they may liquidate those liquid outs too. But I don't have a crystal ball on that. Just the possibility is definitely there, right? No doubt about that. The convexity, I heard the concentrated positions to create convexity. I don't think we need to do that. I don't think we need concentrated positions to create convexity, whatever the definition of convexity here is. But I assume that the link is meant toward the kind of like straddle type of payout, or CTA trend following systems performing well during times of longer term crises or market dislocations, things like this, right? I don't need concentrated positions for that. I just need a diversified portfolio, which will then, as the trends emerge, react in a certain way, but stay diversified.
Anything you want to add to that, Jerry?
I don't think so.
Sure. I would just add, Woody, that 2008 clearly was a point in time where I think a lot of investors made use, as Moritz was saying, made use of the daily liquidity that they could get from their managed futures and trend following strategies. And I think today, and this is obviously purely guesswork from my side, but I think today that there is even more money locked into investments that have even less liquidity than they had back in 2008, because there's been such a search for yield, meaning people have bought more junk bonds and more whatever they're called, leverage loans and all sorts of stuff, more private equity, just to get a return. And I think sometimes maybe it's not really we sometimes joke a little bit about that everybody loves private equity because it has such a smooth return equity curve. Well, because they don't have to make mark to market on their positions, and if they did, it would be probably as volatile as trend following. And I think sometimes people forget the benefit of. I mean, they're again, of course, I'm talking my own book here, but what we deliver, and maybe we don't always deliver the best performance, I'll be the first to admit that, but what we deliver in terms of other things, in terms of diversification, and not least in terms of liquidity, not just liquidity to the investors, but liquidity in the markets to other participants, I think it's hugely underappreciated. But I think what you're saying is that, will there be a bank run on liquid strategies? Doesn't really matter whether it's managed futures. Any liquid strategy in a really bad crisis will suffer redemptions without a doubt. And the good thing is, last time it happened, managed futures managers were there for their investors, and we delivered the liquidity they needed. That's part of the role. As much as we hate doing it, so to speak, and see them leave, then it's the client's money, and they can always have it back, of course. Final point, Woody asked if there's really a disadvantage of using blue chip managed futures mutual funds, meaning the bigger ones, obviously like the one Jerry has. Also, we have a mutual fund in the US. These funds touch so many markets, and managed futures are not really heavily used anyway. Thus, can asset bloat really be a concern? I can't speak for Jerry and Moritz, of course, but in my opinion, I don't see any reason why there should be any concern about some of these strategies becoming too big, as you know, for the foreseeable future. Any views on that, Jerry, Moritz, or?
Yeah, well, I think, is there a problem with too many people trend following, too many CTAs? Maybe. I don't know. I don't know if we've come down on that. I can't imagine that it's not it's an issue, I suppose, with lots of people. And these mutual funds are just knockoffs of the normal program. So if a large manager with $25 billion had a $500 million mutual fund, it probably would trade pari passu to the overall trading program. So it's just, it's a problem or not a problem, but you're not escaping it by getting into a mutual fund. Does that make sense?
Yeah, no, absolutely. I mean, and clearly there are more people who follow trends today, even if they don't want to admit them or call themselves a trend follower. I agree with that I think there is some, you can be concerned about those things, but I don't think necessarily that's, we're at a stage where that, hurts performance. I still think it can hurt. It can push maybe when certain reversals happens. It can certainly create some extra volatility, but you could also argue the other way, and that is that the more people who follow trends, the longer these trends could run, and that's a benefit. So it may change the shape of the performance. I don't think you can conclude that it makes performance worse or better that you have more people. And I still think that overall, certainly if you look at the official industry of trend followers or CTAs, I mean, it's been at 350 billion for I don't know how long, even though market liquidity and volume has gone up significantly over that period of time. And to a large extent, we're only at 350 billion because Bridgewater is included in that number. If you take Bridgewater out, we're significantly smaller. And I don't really know that Bridgewater is a trend follower per se.
But wouldn't you say that that's the opposite of what David Harding said? Trend following is too competitive. There's too many trend followers. It's time to move on to something else. It's fine. But I just want to, we disagree, or you disagree with him. But I think that's exactly, and I think lots of people, even people who still invest, they say, yeah, and you can't discount. I mean, you spend. Even if we have trends and you spend years or 1 year, 2 years, depending upon your look back in these trends, and at the very end, this big crash comes because of vol targeting or too many trend followers trying to escape at the same time, that trade is way less than it would have been in the 90s or the 80s. And so most of the time, there's no impact. We're all going along happily, merrily along, riding these trends. But it can all get screwed at the very end. So you could say, oh, bummer. But that's the whole business, though. It doesn't work as well as it used to, hardly work at all. I don't think we've had enough good trends historically, like we historically have, to sort of make that call now. But many, many people are making that call.
I agree with that, and meaning I agree that a lot of people are making that call right now. My thoughts, sort of just trying to answer it straight away, is why would trends in general be any different today than they were 20 years ago? Why fundamentally would trends be different?
But
one of the reasons.
I don't think that's what we're saying. They're not. Now, we can have a few extra little breakouts that are fake because they're running the stops on the breakouts, and a lot of people trying to get in, and the market in 2019 would not have made that breakout in 1995. That's a bummer. Okay, we take a small loss. Our win percentage is a little bit less. Now, for the next 2 years in that trend, no change. Okay, you're right. There's no change. No one's saying there is a change fundamentally. It's worse than that. Do you mean to tell me just by screwing up the entry and taking a little bit of that profit away and having a slightly less win percentage, and at the very end, the market getting totally crushed with everyone trying to get out, that overall that trend is very, very little changed. But now all of a sudden we're not able to make very much money from it. It's exactly what I'm saying. It's just way too subtle. And you can have trends, better trends, but if those two factors are in there, we've already had to adjust materially with in my opinion, the recognition of this phenomenon by having to become super long term. And so, okay, great, I'll be super long term. It'll be more fluctuation. It's a slightly worse investment. There's more vol in the trends, but at least, there'll be trends. Yes, but it does matter almost exclusively what happens when it turns around. And like, some of these trends like palladium, it's thin market, let's say, but I don't think you can discount the fact that a lot of the stocks that are very liquid can get crushed when everyone goes through the door at the same time, and it screws up the entire trading system.
No, I agree with that, and I think that's why when I I've been saying this before, when I hear someone like a David Harding saying he doesn't think that trend following is as profitable as it used to be, I think that is true, but I don't think it's necessary. I don't think it means that all trend following approaches have become less profitable. That's point number one. Two, I think there is a limit, and I've always maintained that there is a limit to how much one single manager can manage in trend following successfully. I truly believe that. I don't think it means that you can't have. So let's just say that that's $1 billion. So you maybe you can't, as a single manager, trade 25 billion, but could you have 25 managers of $1 billion being successful? I think you could. But I think it's harder if you get to that size of some of these programs because you lose diversification. And I think trend following, it's underrated in terms of the importance of trading all of these markets. If you just end up doing trend following in stocks alone or currencies and bonds and stocks that are highly correlated at times, especially during a crisis, I completely agree with you, Jerry. We're going to end up giving back too much of the profits when the reversal comes. But on the other hand, it is those big managers who are forced to do that are attracting all the AUM. And that is why a lot of investors are disappointed, in my opinion, with the results they're getting from their managers, because they pick the big ones.
I like that. Although I would disagree a little. If I had the 25 billion and I was alone trading the 25 billion versus the 25 managers with 1 billion,
sure.
I would take my time. I would not cause the big sell-off. I would say sell 5 more, sell 10 more. There's not anything on the bid today. Well, then don't do the trade. So I would be disciplined because I have all the money. I'm going to screw myself if I do these indiscriminate buys and sells. Now, if it's 25 individual managers with $1 billion each, with no idea, they're competing, with no idea what other people necessarily are actually going to do, then this stampede can take off. And you can have people acting in their own self-interest, but kind of screwing it for everyone else.
My point with that example is just to say, if you have 25 managers, there's a likelihood that they're not going to be doing exactly the same. So the entry days and the entry and exit days will be slightly different. But if you have one big manager, for example, then their systems will generally, unless they spread it out so much, there could be a little bit more pressure. Where I do think there is a problem, and where there is definitely something that may have changed, not to say it can't be overcome, because if I look at inside our own firm, I definitely see that this is not necessarily something that has deteriorated our returns, at least. But I will say this whole wish for or this whole wave of now the banks suddenly and everyone under the sun can do trend following, or and it's just another factor, and we can do it for nothing, it doesn't cost anything. Of course, that has put a lot of money doing something that looks similar to what we do, and that may change things, but I still think you can find managers who are able to cope with that. I don't, and then of course the other factor I think we have to take into this discussion is, well, maybe it's just a 10-year period where performance maybe have been a little bit below average. it doesn't, and we know a lot of that performance below average is come from the fact that there's no risk-free rate of return. If you add back another 5% of risk-free rate of return that we had in the 90s, do our returns look that different from the 90s? I'm not so sure they do. So there are many small factors we have to take into account when we analyze that, but it is an important debate, and yeah.
I love listening to you guys.
Yeah.
It's an important debate,
super
and
important.
nobody has the firm answer and the final and conclusive answer on that, because it's impossible to have it, right?
It's just about our own beliefs at the end of the day.
And I just would say that if you would have argued the opposite, if you would have taken my argument, Niels, I would have taken yours.
Yeah.
That's what I'm trying to say.
Sure.
Yeah.
I don't know, but
Yeah.
don't tell me it can't happen.
Oh, yeah.
Exactly.
That's all I'm saying. So
Yeah.
that's the bottom line is, here are the sides, here are the arguments. I'm not really sure, because if I was sure, if I was doing more than just rhetoric and arguing a point and debating, I wouldn't be in trend following any longer. If I thought that was true, but it can be true. It cannot be ignored, and there's no evidence that it's not true or that it is true.
Yeah,
but not enough for me, anyways.
Yeah, but it's fascinating to me that one of the big improvements that we made on our side was relating to exits, right? So we actually spent a long time figuring out how can we do better exits, and maybe perhaps part of what we've seen in terms of maintaining our long-term returns, even though it's been a difficult period, has to do with the fact that maybe we have found some ways of dealing better with that scenario that you describe, and which I can't disagree with. I mean, I think there is an impact on all of this. But maybe next time, Jerry, we'll just reverse the roles, and I'll take your side, you could take my side.
Exactly.
One thing to add there, and we touched on that prior to this chat. There are some CTAs making new all-time highs. Without going into the details, but it's not all that. It's no longer working, and what was the Bloomberg article?
It's failing.
Failing, and looking back on past data doesn't work. I mean, sure, difficult environment, but I just want to highlight there are a handful of firms, or even more than a handful of firms, making new highs. So there you go.
There we are. Good stuff. We've got another question from Brian. Brian has a few things that sprang to mind upon hearing our episode number 28. And it actually has to do with returns and Sharpe and all of that. And Brian talks about, or he asks, why do investors use the Sharpe ratio at all, considering returns follow a non-normal distribution? He also asks, if you don't define volatility as risk, then why again would you use Sharpe ratio? And then finally he says, when it comes to Sharpe ratio in general, isn't it the higher the number, the better? ? Why such praise for one Sharpe performance? Granted, 15% returns is fantastic, but wouldn't it be even more impressive if it was coupled with a 3 Sharpe? I think it refers to a comment that you made, Jerry, when we talked about Harding, and you referred to it as a 15% return with a 1 Sharpe, putting him in his own class. I think that's where it came from.
And a quote from him, and I didn't verify the numbers, but I just said, if that is true, that's pretty impressive.
Yeah.
And it could be a situation where he knows as much as me times 10. So he understands. Winton has a paper out there about don't look at the Sharpe, I think.
Okay.
Or the limitations of a Sharpe. I read it years ago. So if you could build a systematic approach with trend, and we all agree with the critique of the Sharpe ratio, it's silly, and but you build this without regard to paying attention of your own internal, choosing the systems and how you're going to trade. It's not unusual for someone to say, I chose these systems. Let's say I'm the number one performer, and I never paid any attention in analyzing how to trade and which systems to choose based upon a Sharpe ratio. And then someone else comes along and says, you're the best trader ever, and you have a 1.0 Sharpe. Thank you. It's would be the gentlemanly thing to say. You don't have to get in some discussion about how Sharpe is crazy, but even not paying attention to Sharpe doesn't mean you're not going to have a good Sharpe. I think that's all he was kind of saying, is that, I may not pay attention to it very much, but I do have a pretty nice one.
And do you have an opinion as to why so many investors prefer Sharpe with its limitations as the go-to?
It's logical. They don't embrace non-normal distribution of trades and systematic approach and taking small losses and everything that we do. So the key characteristic of what we do would be to have a lower Sharpe because we let profits run. And I think that is logical, that they wouldn't. They're stuck in the old way of looking at things. And I think to some degree, to be a little critical of a one Sharpe, which I would have to be honest, for a trend follower, I think it's going down on a limb here, probably going to be wrong, but it's probably has a lot to do with the fact that you're doing vol targeting, and it's a pretend risk measurement. Then, if you're reducing, taking off tremendously winning trades, and you're kind of coming up with a fake Sharpe, because you could stay in that trade for another year, make a lot more money, have a nice drawdown at the end, and look like you were riskier when you, in fact, were not.
Yeah. What are your thoughts, Moritz?
Yeah, I have thoughts on that. I think, the reason the Sharpe ratio is used is just because for investors, it's as easy as breathing in and breathing out. It's such a simple equation. Sometimes if you just, shorten it down to the information ratio and you get rid of the risk-free rate, which is an element of the Sharpe ratio, then it's just return over vol. That's very easy to calculate. Everybody's using it. So it just kind of like became the default, turned into this nice little default that people use. And then, we know about the limitations and, the normal distribution of returns that underlies it and all of that, not being correct. But okay, let's still use that. And there are other ratios, and I must admit, I'm kind of like the same way. I do look at the Sharpe ratio. Yes, I know the flaws, but, getting your head around the omega ratio and the Shortino ratio and this and that ratio, it's kind of like more difficult to put that in perspective and relate that and make comparisons to other managers, say, right? Don't want to say they're not important or shouldn't be looked at. It's just, the Sharpe ratio is so handy. There's one thing I want to mention on one ratio that I really like. It's by my friend Jack Schwager, the gain to pain ratio. That's super simple to work with, and it doesn't use any standard deviation of anything. It just uses your returns as they come in. Simple ratio, great stuff. People should look at that. But I just want to add one thing about the Sharpe ratio. There's a couple of things that kind of like make me upset is when I look at fact sheets and stuff. Well, one of the things in finance is when, reporters, they speak about the performance of a stock market in points. The Dow is up 800 points or 1,200 points, or the S&P is up 60 points, and they say that's the greatest performance ever. What points is completely meaningless, right? And the other thing is managers or whoever it is reporting Sharpe ratios on their fact sheets with a negative numerator. So if you have a negative rate of return, then the greater the denominator, being the volatility, the higher your Sharpe ratio, right? So if you are, an underperforming manager, you have negative returns, then increasing your vol increases your Sharpe ratio, which is the silliness of the thing. So the Sharpe ratio isn't really defined if your return is negative. And yet even professionals, or maybe they want to call themselves professionals but really aren't, produce fact sheets with, Sharpe ratios shown, but returns being negative. And that just, caused me to scratch my head.
Yeah, no, I mean, and the funny thing to me in all of this discussion is that, again, a lot of people, of course, certainly investors that I'm sure the three of us come across, are searching for strategies with a high Sharpe ratio. At the same time, they have no problem with equities. Well, I mean, equities, the long-term Sharpe of an equity market is around 0.4, which is not really that different from a long-term Sharpe of a trend follower. So it's kind of funny, and of course we know why the human biases in terms of our risk tolerance and all of that stuff. It gravitates us towards high sharp strategy. But just to make a quick comment on the whole thing about a Sharpe of 3, I just don't really believe that those strategies exist for more than a short period of time, yeah. I mean, a lot of people have the aim to deliver returns that are equal to the risk, meaning a Sharpe of 1. But of course, trend following is a strategy that doesn't really cater towards a high Sharpe ratio, but you can make a hell of a decent compound return even with a Sharpe of 0.5 or 0.6 without a doubt. Great stuff. Thanks, Brian, for your question. And just a quick plug, if you have questions for us, just send them by email to info@toptradersunplugged.com, and we will do our best to bring it up the following weekend. Sam has provided questions before. Appreciate it, Sam. This time, Sam says, with the markets and mechanisms you all trade, assets tend to gap pretty frequently, whether it be daily or weekly. Coming from currencies, there are much fewer gaps, so I haven't thought much about this dynamic until now. I know you do not consider gaps as part of the strategy, i.e., just let the market do what it will and live with it. However, I'm wondering if you all have any thoughts/research on the impact of gaps. Do you think it washes out in the end? Do you think that there is or should be a gap in a certain direction more frequently than the other direction based on trend? Perhaps if an asset is in an uptrend, gaps typically favor the position rather than hinder it. Yeah. Thanks for the questions, Sam. Moritz, why don't we start with you? What do you think about gaps?
Mind the gap. That's what you read in London.
That is true.
No, I have really difficult. I'm thinking about I want to give a constructive answer, but gaps are part of the data. They happen. They cannot be prevented. So I have to work with them. I don't, mind them, and I don't love them. I don't hate them. It's what can I say? I'm trying to find a good answer to that, but I really don't have one.
Fair enough. Jerry, any thoughts?
Well, my understanding is gaps are sort of rarer these days because the markets close and they open up 15 minutes later.
That's right.
But gaps are great. And I think it's, I think we talked about this idea a few weeks ago or last week where we see this market and it's gotten away from us and it's really strong. And I wish I had bought it earlier. And how hard is it to sort of get in there when the market is getting away from us? So I think gaps should be celebrated and bought. If it's part of your system, just great. It's even better. You could have gotten a good fill and feel good about it, or chase it and kind of take that pain of having to buy even a higher price. So I think they're fine, and I don't think I know the answers. I haven't done the analysis of whether they happen more or less in up gaps, happen in uptrends or whatever, but I don't think they're anything to sort of pay attention to.
Right. And I think I have nothing really to add to that. But I will say, Sam, that I think Jerry made a very important point, because you make the observation that you're not really used to gaps in currencies. And that is because I think currencies have, probably been, always trading more or less 24 hours a day. So when you look at the data, it doesn't really look like there was a gap. I think if you went back to when the futures markets, even for currencies, were open outcry, 10 hours a day or whatever, you probably would see more gaps. But nowadays, it's not that clear. And I think the more and more markets that are going the electronic route, you'll probably see less of that. And at the end of the day, the data is the data. And I think, again, it's the robustness of a trend following strategy is that we can cope with that as well. But I have no idea whether gaps occur more in favor of the trend or not. But great question. Appreciate it, Sam. Next question is from Andrew. Andrew is based over here in my neck of the world. And Andrew has a couple of questions that are a little bit different to what we normally get. One question is about the cash reserve. So it kind of ties a little bit into what we talked about earlier, where we talked about the fact that we don't trade much of the cash. Most of our cash actually sits in cash or in cash equivalent instruments such as short-dated bonds, etc., etc. And so Andrew asks, first question is, on your cash reserves, do you increase your bond purchases based on trend following signals? So let me start out with this one. So in our case, Andrew, we so some managers handle cash management, so to speak, in-house. That has been that has been done for decades. I would say that was part of the role of the CTA, was to also make sure the cash was secured. I think from our point of view, the financial crisis changed a few things. You saw that what seemed to be quote unquote safe places to deposit your cash, or short dated money market funds, suddenly weren't as safe as you had hoped for. And some funds were even frozen for a while, et cetera, et cetera. So on our side, we employ a cash manager who is specialized in this field, and whose only role it is to first and foremost keep the cash safe, because it is the vast majority of the AUM we manage is cash that we don't need for margin purposes. So it's very important to keep it safe for our investors. So that's what they do, and they do that through investing in hundreds of line items within a certain set of rules that we have given them. So in their case, absolutely no, they would not look at any trend following signal to base their investments on, and also the duration of these bond purchases that they do are pretty short. So you wouldn't even be able to do trend following on that. But I guess what you could see is that, say, for example, they're expecting lower bond prices, so higher yields, they might favor floating rate notes as part of their investments rather than fixed coupons. So things like that. So anyways, we don't apply any trend following techniques onto the cash management side. The second question, and I'll let Jerry and Moritz chime in on this as well. But the second question is specifically, you're asking, how are you using swaps at Dun in relation to fees? Now, and this comes, I think, from a previous episode that you listened to where we talked about swaps. We don't use swaps as part of our trading, but in certain structures, such as US mutual funds, sometimes you need to swap the return back into the fund for regulatory reasons, such as, and it's a little bit outside my comfort zone, but I think, for example, because we choose to have 0% management fee, but we have a performance fee instead, I think the way you have to do it, as far as I understand, is you have to swap the net return after performance fee into the mutual fund. There may be other ways of doing it, but I'm just saying I think that is why we choose to do that. But it shouldn't have any impact on performance per se. There might be a little cost for the swap itself. In our offshore fund, we don't need to do it. In our UCITS fund, you can either do, if you want to trade commodities inside a UCITS fund, you can use, I think, swaps for that. We don't do that. We use structured notes, which is slightly different. But there are certain regulatory constraints when you get onshore, either in the US or in Europe, that you have to adhere to, of course, and therefore sometimes you need to package some of your positions into either a swap or a structured note to achieve that. So that's from our perspective. Jerry, Moritz, any views on the use of swaps? I mean, I should just, before I say that, I should say that some managers, of course, use swaps to trade, meaning if they want to have a large exposure to a certain commodity where they can't do it in the futures markets, then they may use the swap market to get that exposure, but that's completely different, and we don't get involved in any of that.
Yeah, so short answer on the swaps, I'm not trading any OTC derivatives at the moment. There's no ISDA in place or anything like that. Just want to mention that, the firms that trade OTC derivatives, swaps, for instance, most of those are now centrally cleared. So it's, less risky in terms of counterparty risk than it used to be. If you want to, if you can say that way. But as far as the cash goes, managed it myself. And, this is all short dated, secured bonds and bills for the most part, and that's about it.
Cool. Any swaps on your side, Jerry?
No swaps, but you did a good job of explaining that they get a undeserved negative reputation sometimes, deserved sometimes, but they're a handy, useful tool to that allows for in some situations are necessary. That and the bottom line is they're great sometimes because it's what's needed to improve your portfolio, which should contain a lot of CTAs and lots of different markets. So I think that overall they're complicated, but very handy and useful.
Sure. We're coming up to an hour and a half on our conversation, so we appreciate those of you who are still with us. But the questions have been plenty and good ones. So we're gonna round off with the final question, actually coming from Sam again. But I think it's a good question. It's a fun question, and I think it's useful to make sure we get that done as well. And it goes actually to a specific kind of trade that he was asking us about, and I think we all were probably looking at our historical trades during the week to see how it fits in. But the question is, in general, do you think there is a period that is too long term? As an example, you may recall the big downtrend in the euro that began in the summer/fall of 2014. My longest time frame within my strategy would not have exited that position until June of 2017, about 2.75 years in that position. Using this as context, where does this fall on the spectrum when you think long term? Of course, this is an example for a very strong trend that bottomed out with very nice sideways consolidation before rising, really ideal. This also means that the long trade on the euro for much of 2017 and into 2018 was only a small profit on this time frame. So I think we all probably checked in and looked at how we handled that particular trade to see whether Sam is just way too long or whether, in fact, it's pretty normal to have a trade like that. So, Moritz, Jerry, what do you think about this example?
I think it's pretty normal to have a trade like that. I see trades like this, multi-year trades, 2-3 year trades. So it's part of my system. So I don't think it's unusual what Sam is describing there. And to be honest, the longer the trade lasts, the better it normally is. So I don't mind them.
Absolutely.
Yeah, I like that. That was a great trade, and Sam and I have similar systems in that regard, at least on that particular trade. You can just sort of look, get a general indication of what he was looking at just by overlaying some moving averages or breakouts. And so I think that, at least guessing on that one, it looks like that's a fine way to trade. I don't think that I would be able to pass judgment on that trade just by saying, well, yes or no, is it a good trade because I was in for over 2 years, that same parameter set might, in the next euro trade, maybe the trade will last a week or a month. It's hard to say. So if the back test gives you some good indication that at that sort of patience and time frame and given the market that a possibility of volatility and rallying and then going back down, and which didn't probably occur in this trade as he describes it, then that's what you got to go by. The characteristics of following that great system, they're interesting. It's just trivia, though.
Yeah, absolutely. And from our point of view, we were in that trade more or less at the same time. We didn't have the same exposure throughout that trade, and there certainly came a time, I think, in around the summer of 2016, where it was pretty close to getting out before we saw a little bit more of a downwards push in the euro and so on and so forth. But no, I agree. These are some of the usually the better trades when they can last that long. So thanks everyone, Sam, Andrew, Brian, Woody, and John, for your questions. Keep them coming. info@toptradersunplugged.com is where you can send them in. I'm just going to quickly run through the performance as we have it so far in the month of April. This is as of Thursday. So yesterday, I think, was a pretty flat day, at least if I look at our stuff. But BTOP 50 index, flat for the month, up 1.67 for the year. SocGen CTA index, down 14 basis points for the month of April, up 1.77 for the year. SocGen trend index, down 0.25% for April, up 2.63 for the year. SocGen short-term traders index, down almost 1% so far in April, and down 2.63 for the year, so still struggling a bit. And then the Bridge Alternative Index, down 19 basis points. As of Wednesday, I noticed they had not updated, and then up 73 basis points for the year so far. Any final thoughts from you, Jerry, Moritz, other than you're going to be watching some basketball, Jerry, in a few hours?
Yes, a few hours basketball. Hopefully we advance, and I'll be here Monday night as well. So, but I enjoyed it, and it's hard to believe we can go an hour and a half and still have more in the tank. I'm pretty sure, but let's just call it a game right now.
Yeah, absolutely.
And best of luck for the game tonight.
Yeah, thank you.
Yeah, absolutely. Do you want to come with any have you come up with new taglines or slogans that we need to hear today?
No, but I'm game focused today as well. We have a important soccer game happening in 1.5 hours from now, which is Bayern Munich versus Dortmund. So this is probably one of the decisive games of this year's Bundesliga season, and one of those must-watch type of things. So looking forward to that. And other than that, well, no, not changing. Happy trading.
Do you remember yours, Jerry? Or
Of course not.
Okay, fair enough. Anyways, if you like what you heard, please help us by giving us a rating and review on iTunes, because it really does help others discover the show. And of course, if you wouldn't mind, share this episode with a like-minded friend. One share is all we ask for. From Jerry, Moritz, and me, thanks so much for listening. And we look forward to being back with you next week on the Systematic Investor Series. And in the meantime, have a great week.
Thanks for listening to the Systematic Investor Podcast Series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.